I recently interviewed Kelly Tomlin, the president of the JPSCO, on some important developments concerning the financials of that listed company at a time when the JPSCO and other players are expected to play their part in lowering electricity rates while making a profit. Kelly, first of all, your net profit for 2013 fell precipitously, 25% fall from 12.3 million US dollars to 9.2. How so?
Well, primarily the sales have been reducing based on our customers' conservation efforts, which we applaud, in addition to some of our customers going off the grid, and really the economic challenges we all are facing really puts a downward pressure on our sales. So it's primarily due to a decrease in sales.
What level of delinquency are you seeing?
We average about 58 days for our customers, where our vendors usually require 30 days. So that is a significant challenge for us.
Energy World International has been approved by both the OUR and the Minister of Energy as the entity to execute Jamaica's 360 megawatt project. I asked Kelly about the possible partnership with EWI.
First of all, they don't have to partner with us.
Okay.
We have entered into an MOU to explore a partnership. Obviously, EWI has been very busy working on their license, and they have informed us that after the license is concluded, we'll go back into our partnership discussions. So we are, I'm assuming, going to restart those discussions now.
Okay, so it's a discussion. There is no guarantee that there will be a partnership then?
No, there's no guarantee. We both have indicated that we would prefer a partnership, but really it requires us to come back to the table and see where both the parties are. There seems to be some significant changes since our earlier discussions, so we'll need to revisit those.
The JPSCO's overstated accounts prompted the JPSCO's management to write off 55 million US dollars in unrealized gains. That's unprecedented in the company's history, so I asked Kelly the rationale behind the overstated accounts regarding unbilled revenues, an issue that's been around for over a decade, and the moves to correct this at a time when sales were down.
Well, it has, but I would like to go back just a minute. As you correctly identified, that our sales have been going down and our profits obviously go down with our sales. But I do want to point out that we have taken a very stringent view of all our operations. Our costs, our operating costs, have gone down significantly, more than 10%, about 15% in fact. So our operating reviews have been going on for the last year and a half, and we've looked at every expenditure, and you'll see that in our operating expenses and its decline. Similar to that, in a like fashion, we have looked at all our financial accounts and have taken a very strict view. And when we looked at the unbilled revenues, we had noticed that over the past 13 years that it's grown to a level that really I can't say that we would be able to collect within the next 30 days. So we've taken the view that let's take that adjustment now and make that account more in line with what we think is possible and probable. And we're taking that right off today to really clean up our accounts before we go into the rate case with the OUR. What we're actually doing right now is taking a 55 million US dollar write-off to our retained earnings to bring that number back in line. I think it's important to remember that that's grown over 13 years and that we have had the same auditors for 5 years. But because of the way losses are calculated into the unbilled revenues, it's more complex than what I'm used to. Because typically what you would see is any month's revenue, about half of that's not billed. As you can understand, you're using power up to the 31st of a month or 30th of the month, and we haven't billed you for all that, right? And depending on our meter cycles, it might be, half, 50%, or something even greater. But because of the way our losses work and how we have made adjustments over time, meaning that if we did find a loss situation that we've built in something different, and how we accounted for the fluctuation in losses over time made that formula more complex. We've gone to a simpler formula now, and unfortunately, but fortunately, it has resulted to our shareholders and a $55 million reduction to our retained earnings. But it has had no customer impact, and it will not have a customer impact. In fact, one of the reasons we're taking this adjustment now is that as we go into a rate case, we don't want our assets to be overstated. And we want to be able to come to the OUR with a rate case with really accurate accounts, and that's the reason we're taking that write-off this year.
So this write-off is a board decision, or it's a decision at the operational level?
It's a decision at the operational level. When we started to look at this number with our auditors, it became apparent to us that the number that was indicated in unbilled revenues would not be collectible in the next 30 days. So we have decided to take a new approach, a simpler approach that may not capture what is unbilled in the losses regime, but will be a simpler approach. We will be discussing this with the OUR as well. So really it is consistent with our practice over the last 2 years, looking at every expenditure, every number, and really trying to bring it more in line with reality and making sure it is as accurate as possible.
A significant hit to the JPSCO shareholders, but according to the JPSCO's president, Kelly Tomlin, it has had no adverse impact on consumers. But how does the board feel about this drastic accounting measure to write off $55 million in retained earnings?
No board likes restatements. No board likes write-offs to retained earnings. But there comes a time, and we're at that time, where you do a cleanup. You take a fresh look at your organization at every level. We've made changes everywhere you look. We've made changes in our leadership. We've made changes in our O&M practices. We've made changes, I hope, in the way we are dealing with our customers. We're not perfect. We'll continue to improve on that. But I think it's very consistent with our approach. Leave no rock unturned. Commit to being brilliant in our business. And when you look at your financial accounts and you look at them with fresh eyes and you say, we're going into a rate case that will determine any rate increase, and we take that very seriously, we have to make sure that these accounts are accurate. And nobody likes restatements. They do happen. And I hope that these are more accurate accounts. And while, as the Prime Minister said, we have to endure some hard times right now, that ultimately it leads to somewhere a better place, that you do and you are operating with the appropriate information.
JPSCO's Kelly Tomlin there in a refreshingly candid and transparent response to my searing queries regarding the company's accounts, and particularly the decision to write off $55 million in retained earnings. That's your wealth for this week. I'm Owen James.